Meet Dave. He's been trading for about 2 years, which in Wall Street terms still makes him pretty new to the game. His portfolio is up 13% this year. He caught a lucky win on a crypto meme coin, and now his confidence is through the roof. Dave spends his time watching the Wolf of Wall Street, talking about random biotech stocks to strangers, and convincing himself he's built for full-time trading. So, naturally, Dave decides to level up. He calls his broker, slightly adjusts his net worth, and gets approved for options trading. Fast forward 3 months, Dave is fully leveraged into out-of-the-money Tesla calls. His strategy: buy high, sell even higher. Risk management: hope. Meanwhile, at home, why is $13,000 missing from our savings account? 3 more months pass, and the Federal Reserve raises interest rates. Dave's portfolio is now down 67%, and his wife's new hobby is Googling how to divorce a man who thinks he's a market genius. So this brings us to today's question: why do the least experienced investors sometimes win the most? The answer lies in something called the Dunning-Kruger Effect. In markets, it explains why beginners often feel like experts, while actual experts constantly second-guess themselves. And Dave? He's convinced his losses are due to market manipulation. Look at the market since 2020. You could have picked almost any stock and made money. And if you were on the early side of that confidence curve, high confidence, low experience, you probably outperformed the market. Traditional investors focus on fundamentals and valuations, but in recent years, what actually outperformed? Companies trading at extreme valuations, trend-driven plays that barely make sense, and investors hyping their positions to anyone who will listen. Zoom out even further, and it becomes obvious. We've been in one of the strongest bull markets in history, roughly 17 years, with over 700% total returns. Since 2009, markets have mostly moved in one direction, up. So, realistically, almost any investment during this period had a good chance of making money. And because of that, high-risk, aggressive strategies ended up outperforming. But like every long run, this doesn't last forever. At some point, it ends. The real question is, when and how do you prepare for it? You've got 2 choices. Option 1, sit in cash, like some of the biggest investors do. Safe, but not exactly exciting. Option 2, stay fully invested, take big risks, and when things go wrong, blame someone else. The Fed, politicians, market makers, it doesn't matter who, as long as it's not you. So back to the main question. Why do the dumbest investors win? Simple. Because retail investors are drawn to high volatility, high beta stocks. Let's break that down quickly. Beta measures how much a stock moves compared to the overall market. For example, if a stock has a beta of 1.3, it's about 30% more volatile than the market. If the market goes up 2%, that stock might go up around 2.6%. And if the market drops 2%, it might fall around 2.6%. Here's why that matters. When markets are going up, a high beta portfolio will outperform, and suddenly Dave looks like a genius. But when markets fall, that same portfolio drops even faster, and reality hits. In a bull market, Dave looks like the next big investor. In a bear market, Dave becomes a cautionary tale. So next time someone brags about their latest 10 times crypto win, just remember, everyone's a genius in a bull market.